Okay, welcome back to Not Financial Advice. Today we're going to be taking a look at Intel and its $46 stock right after this.
You need to diversify your bonds.
The only problem you're gonna have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
When it comes to Intel, what we have here is the world's largest manufacturer of chips or semiconductors. And so they're an American based company. They've been a very powerful company for a very long time. There have been times in the past when the stock has performed better than it has today, but there's definitely some things going on that are worthy of our attention. And, with that in mind, I'll ask you to like the video and subscribe to the channel. What we're going to do to start out is take a look at whatever affiliation I may have with the stock. So, it looks like I own 26 shares of Intel and I'm up about 20%. So it's one of these 3.5% allocation pieces of my portfolio. And I'm up a nice amount, $206. That wasn't always the case. And this is as much as a video about Intel, a little bit of a video about investor psychology, investor behavior. Because taking a look at this price chart, we can see there's been a lot of volatility, a lot of activity that's been going on with this. So just the first thing to note about Intel stock, which is trading for $46, is that it's traded closer to $70 back before the 2099.com bubble burst and the ensuing recession. So this company at one point, traded in that $75 range, and it has never returned to that level. And this is sort of more of a story about market euphoria and irrationality because in 1999 and 2000, we'll look at it here in a second on Qualtrim, but the amount of free cash flow or revenue that they were doing 23 years ago was significantly less than what they're doing today. Yet the company was rewarded back then and more recently has been punished today. But the stock has made a little bit of a rebound. And so we're talking about it today, but it didn't always be that way. Like the video, subscribe to the channel. So what you can see here is after this stock bottomed out after the dot-com bubble, um, it had this trajectory. There were times that it traded under value. There were times that it traded over value, times that it might have traded significantly over value, a correction, and now another correction. And so, just based on this, we may have reasons to believe the stock is overpriced, but we're going to determine that together. So let's get rid of all of this here that we have on our screen, and we're going to actually take advantage of this cool new tool that Google has, just where it gives you sort of the high level headlines of a company and what's happened with it. So going uh, back to the beginning. So it looks like in 1999, as the company was moving up, they looked to buy at a given point in 1999. The company was up 335%, and they wanted to buy something, and their stock went down a little bit that day. So that's just sort of a snapshot, a picture in time. Um, this probably was super duper painful for some people. Uh, while all of us were unaware of what was going on living in the 90s. But then here, as we followed the history on Intel and its stock, um, after it crashed, Intel had some decent quarters up and down, traded sideways for a long, long time, essentially traded sideways 2002 until about 2014. So, um, 12 years, the company traded sideways while paying a massive dividend. But that's a lost decade or more in this stock, was what some experienced with it. And so I think a lot of people have felt burned by this stock throughout time, throughout history. And that might be why in 2009, um, Intel had some good news in earnings liftoff, according to Ars Technica, and people were so mad at the stock that they had a good day and they went down 3%. So, following along here, um, 2015, they had a good day. It looks like more of the conversation was about acquisitions and mergers. This is a company that's been public um, since 1968, so 78, 88, 98, 2008, 2028. So, going on 50 or so years here, mergers and acquisitions are part of a company that's 50 years old. And it's been public and gone up in value significantly. But the question is, what is this $56 stock worth today? So, going to more recent times, and this is where the stock started to have significant problems in very recent history, down 53% from a pretty high level. Intel stock fell as next generation of chips were delayed, sending AMD shares higher. And so I want to come in here and go through the different bullet points, the different headlines that Google's highlighted for us. So in 2019, and these are all different than what we looked at previously, but in 2019, as Intel plunges, here's what every major analyst has to say about its dismal report. This is humorous. Uh, July 17th, 2020, during the dark times, Intel stock falls as next generation of chips delayed, sending AMD shares higher. Okay, we saw that one. So that brought it down 16%. Now coming into recent history. So Intel shares fall after component shortages hurt PC chip business. So this was during a time when everyone was buying laptops and desktops with stimulus checks. And so now the picture is getting a little bit more clear. And we're going to look at um, some of the results that have sent the stock higher. So, shock and awe. Cost cuts rocket Intel stock up more than 10% to best day since forever ago. Okay, so there's some austerity happening, a new sheriff in town, and then recently, Intel shares pop after foundry revenue quadrupled amid rising demand for AI. And there's that word AI. It's up 30% since then. And after this cost savings measure plan, whatever was put into place, it looks like this stock is up from its lows 79%. 79% is what comes up. $79. So the company is off of its lows by 79%, although from its most recent peak, let's just look in the last 5 years. So this was in its most recent peak, 68.26. Was it higher here? Okay, 68.47. So the company's up 79% from its lowest point, but it's also down 33% from its most recent high. So, the question I think at this point is, can it rise another 33%? And we're going to figure that out together. So, up 79% from its recent highs. We've already taken a look and seen the fact that I own some. So, let's take a look over here on Qualtrum. Qualtrum is a great piece of software that I pay for that helps me to analyze stocks, but I'm not affiliated with Qualtrum. So I'll leave a link for Qualtrum in the description below and ask you to like the video and subscribe to the channel if you haven't already. But what we're going to be able to do here at Qualtrum is get a better sense of what Intel stock is worth on a per share basis as Qualtrum curates recent financial performance and metrics down to the quarterly level, but also back 20, 30 plus years. And so it puts all of the most vital information in one spot for us to look at. And I'm a big fan of Qualtrim. So, like I said, I'll put a link for it in the description below. But what we can see here is we have a $46 stock. And a little news update here with Intel shares trading higher after Bank of America Securities upgrades the stock from underperform to neutral and raises its price target from $32 to $50. It's a pretty big jump. So I guess they were wrong when they said 32, but now people are thinking that they're right that they say 50. All right. Let's see what else we can ascertain with Intel stock. So very large cap company, $195 billion market cap, a forward PE of 26, which is a little bit high. In the most recent quarter, they're losing money on a cash flow basis. They've got a lot of cash, but they have even more debt. A lot of debt. One thing to note about that, with the moves in the Federal Reserve recently, with Jerome Powell, praising the reduction in inflation and prophesizing 3 rate cuts in 2024, it seems like companies with a little bit more leverage, or with a good amount of leverage, otherwise quality companies with a lot of debt on their balance sheets, have seen a pop in the last week or so since Jerome Powell's most recent comments. So that's just a very close and granular little commentary here. But the dividend on the company is pretty small for a 50-year-old company, and they're not doing a good job keeping up with it right now. Spoiler alert on Intel, and a big part of this conversation is about capital expenditure. So let me pause for a second and ask you to like the video and subscribe to the channel, but also sort of give you the high level overview of why I own this company. Before I mention that, I'll say that this 50-year-old large cap company is incredibly complex. And disclaimer, I don't fully understand it. But what I do know and what made me confident enough to invest money in the company initially was threefold. Um, I'm on a computer, I use computers, I'm not a computer expert, but I understand that chips or microprocessors, they're the heart and the brain of all of the devices that surround us in modern life. Number one. Number two, um, recently a new CEO, Pat Gesslinger, was brought in. I think he's a very smart, competent man. So I like the management. Um, a lot of this bet is on him. Understanding that chips are the heart and brain of the devices that surround us in this world. I also understand that Intel, as the world's largest chip manufacturer, is based in America, with the majority of its commerce and manufacturing and operations residing here in America. And I view Intel in the same way that Washington, D.C. would view Google or Rockwell, not Rockwell, but Google or Northrop Grumman, Lockheed Martin. So I believe that the US federal government views Intel in the same way that they'd look at Google or a missile manufacturer as a strategic asset of the United States. And so that's what my investment was based on, as well as looking over some qualitative and quantitative things. But Intel is um, of a national security interest to the United States with a smart leader, largest chip manufacturer in the world. Chips power our modern life. And that's the whole investment thesis. And that's what gave me the faith to hold this stock when its price was down. Where did I start buying it? Um, I started buying it probably around $55 a share. So I've held this stock when it was down 54%, 55%. Can you do that? That would be the question. Anytime you buy an individual stock, if it goes down 55%, can you not only hold it but buy more? And in this case, I'm pretty proud of myself because I did hold it and I did buy more. And I wrote it off and I said, I'll check back in 10 or 15 years. And I checked back 15 months later and I was actually up by 20% because I bought it here and here and here and watched the stock return and saw returns of around 20%. And so these are all thoughts and questions that we have to ask ourselves. So let's keep it moving. I'll ask you to like the video, subscribe to the channel. And we've gone through all these different metrics here. So let's look at revenue. Remember I said that its stock was $75 in 2000 and 1999. So in revenue for those years, they did about $30 billion of revenue, and their stock was 2 times higher than it was in 2020 when they had done 2.5 times more revenue in 2020, but the stock price was inverted from the revenue. So 2020, 78 billion in revenue, 2000, $34 billion in revenue. Let's go back and look at this chart again. So 2000, there's their stock price when they did $35 billion in revenue, whatever. Here's their stock price when they're doing frickin' $80 billion or whatever. So, that shows you a little bit about market irrationality. What we're looking at here, this is only the most recent 3 quarters. So if I project this very, very, very conservatively, we're looking at growth over the last 10 years of like 4.1% or 4.2%. That's the metric I'm going to be using in our rough DCF. But it's just all very interesting stuff. So as far as revenue goes, it's up and to the right. That's a check mark. Let's look at free cash flow. So I mentioned earlier, a big part of this stock and its story is capital expenditures. Long story short, revenue's up and to the right. I think this is not the future state of things. It's a 1 or 2 year off thing, and it'll recover with much higher profits. So free cash flow, we're going to give this a check mark. But I'll stop for a second to show you how weird things can be. So people really felt burned by this stock in 2000, right? So in 2020, they had $19 billion of free cash flow, even before um, the supply chain issues and the capital expenditure, which I've yet to explain to you guys. So even before that, they were doing $19 billion of free cash flow in 2020, and the stock was, half of what it was in 2000 when they only did $6 billion of free cash flow. It's just weird. So all things that I looked at before I first bought it, feeling that the stock was definitely undervalued with the cash flows it was putting up at this time. All right. And so I've averaged these last 5 numbers. We're going to be using that in our rough DCF. But if I didn't mention already, free cash flow as well as revenue were both check marks. Let's take a look at cash and debt. They have more debt than cash, and it's going up. That's an X mark. Dividends. They recently cut their dividends, so that's an X mark. Shares outstanding. They've got a long track record of buying back shares. We like that. That's a check mark. Their ability to have positive returns on capital employed. That's actually better than I thought it was. So besides the recent troubles, they've done all over 10%. Closer to 15%. Okay, this is a pretty enthusiastic check mark, and it makes me excited about the investments they're making in themselves, building new foundries, which are factories where you build chips in Ohio. This is a big check mark. Um, they've had a lot of capital expenditures and other expenses, so we're not able to intelligently look at valuation, so we're going to leave that off. Um, I think that covers it. So this part is super duper informative and important. So before I show it to you, I'm going to ask you to like the video and subscribe to the channel if you haven't already. But what we need to see here is what is going on with CEO Pat Gesslinger's um, purchases of this company. So at $38 and below, he's bought recently. He bought at the end of October. So just weeks ago, he bought uh, so weeks ago he bought, what is this? $400,000 of this stock. $400,000 very recently. He bought $400,000. The only reason a CEO buys shares of his own company is because he thinks the price is going to go up. Don't forget that. That's from Peter Lynch. So $400,000 he bought a few months ago. He bought $600,000. So the CEO's bought $1 million. More, more, $1 million, 1.1. Okay, so the CEO's bought like $1.5 million in stock. The CEO's bought $1.5 million in stock in the last 6 months. And then the stock price went up. Huh. What do you say? So insider buys, check mark. Okay. So we're going to pause here before we get back to finding out what the valuation on this company is. It trades for $46. We're going to look at some of the qualitative stuff. If I haven't explained it to you already, we're going to blast through this really quick before we sort of talk about what the value of this $46 stock might be. I'll ask you to like the video and subscribe to the channel if you haven't already, but let's go through some of these key takeaways. So, unlike some of its competitors, big names that you know, unlike some of its competitors, Intel fabricates its own chips. Other companies are fabless, but Intel makes its products. In 2020, Intel lost a long-standing client, which was Apple. It was something like 3% of their revenue. It's not actually that big of a deal. Um, Intel has lost market share to other foundries such as Taiwan Semiconductor, as well as Samsung Electronics. They're both fabs. AMD and NVDA, I believe, are both fabless. So, in response to criticism from an activist hedge fund, Intel replaced CEO Bob Swan with VMware CEO Pat Gesslinger February 2021. He came in, he shook it up, and started buying a lot of stock. Intel broke ground in 2022 on a new mega semiconductor plant in Ohio. So this is important. This is one of the effects that might not have been able to be predicted in the pandemic, but Amazon had a year and a half where they were not making money. On paper, it looked as if they were losing money. They doubled their distribution capabilities. Amazon did. But at the same time, when we had this sudden rush in demand for computers, laptops, and desktops, and Intel couldn't deliver the goods, Pat Gesslinger said, "Oh no, no, no! He started working there when he was a young man, and went on to found or partner with other companies like VMware. He's a Intel pro. He's an Intel uh, you know leader." A lot of a lot of um, deep roots at this company. The CEO is, so he's a true believer, a real Intel man, and he came back and from my perspective, there was a big demand and they couldn't meet demand. And so he said, okay. And he just decided to invest something like $20 billion to build some new facilities. And so Wall Street didn't like that because Wall Street is very short sighted. Remember that price target going from $32 to 50. All right. And so that's the story of what's going on with this company. So the semiconductor industry uses the term fabless to describe a company that designs and markets its chips while outsourcing fabrication to third party manufacturers. Intel's biggest competitor, NVIDIA and Qualcomm, are fabless companies. Now, there's some things that are good about that. It's asset light, this and that, but you're not ultimately in control. You're not ultimately in control. So, competitive world of chip sourcing. So one of the guys that founded Intel, his last name was Moore. It's kind of boring, but it's important, especially if you're a big computer guy. So the concept is every 2 years, the power of a chip is going to double. And that's called Moore's law. It's like lore in chips, which is boring to me. More of a big picture guy. So in 2022, Intel had three major customers that were responsible for 42% of the company's net revenue: Dell, Lenovo, and HP. So it's important to understand that big part of what Intel does is sell chips to people who make computers, laptops, and desktops. So it's very much so cyclical and tied to consumer discretionary. But there are other things like its foundry, where it's offering to manufacture chips for its competitors. Uh, Services that they offer, providing chips for data centers. Things, flashy keywords that are probably 1 or 2 or 5% of their revenue. Things like Internet of Things, making chips for all of the items that surround us in our everyday existence. Things like AI and cloud. These are parts of their revenue and future drivers going forward, but 42% of the revenue is for computers, desktops, and laptops. And in fact, I just talked about it, but here are the different reportable groups for income on the company: client computing group, data center group, Internet of Things group, non-volatile memory solutions group, programmable solutions group. If you want to get a little bit better idea of the different business segments that Intel reports under, because I think it's important, I'm going to blow it up there and pause it there if you want to read that a little bit more. 3, 2, 1. Okay. Like the video, subscribe to the channel if you haven't already. We're getting to the end of it. So, um, they were sucking real hard, and then some activists, hedge fund people said you should have a better leader, and then they brought in a better leader. That's that. So September of 22, so like a little bit over a year ago, Intel began construction of a massive facility near Columbus, Ohio, taking advantage of billions of dollars from subsidies in the federal government CHIPS Act. That's a good thing for the investor. Biden administration highlighted the project as a critical step towards bringing manufacturing jobs back to the U.S. in a key measure, reinforcing the country's economic and national security. I think I felt that way even before I invested in it, so that's cool. Intel's headquartered in Santa Clara, California. In addition, Intel maintains presence around the world with manufacturing facilities in countries including Israel, Ireland, and China. So none of its eggs all in one basket. That's pretty cool. Bottom line, some companies dominate an industry but fail to innovate and fall into irrelevance, e.g., Howard Johnson and Kodak. Others have great ideas but never manage to capitalize on them. The companies that can leverage intellectual firepower and commanding market share are companies that can stay both powerful and relevant for decades. While Intel has enjoyed 50 years of dominance in the semiconductor industry, it faces competition from rivals like Taiwan Semiconductor, etc. So its competition could put Intel's future dominance in the semiconductor industry in question. That's true. I think that they probably will remain dominant, and even if, as I was mentioning, even if it doesn't maintain its dominance as the number one manufacturer of chips, forever. It doesn't need to be the number one manufacturer of chips to still be a successful investment. So, what I would say is on this stock, um, as long as you have a long term perspective, say 15 years. I think that the value of Intel is being unlocked now, and we have seen a period where the stock has, been flat for a decade. But I think that dividend growth will come back to this company. I think the value is being unlocked now. I think there's a great chance they remain the most dominant chip company in the world. And if not, they have the ability to produce massive, massive, massive amounts of free cash flow with their return on capital employed after their investment cycle in this new manufacturing facility in Ohio is behind them. I see free cash flow going higher in the future. So we have a $46 stock. Let's get over to our handy dandy little free cash flow calculator and see what this $46 stock is worth on a per share basis. So, coming over here, this is all of the data, metrics, and what have you that I've imported from Qualtrum. And so, this is the average of free cash flow over the last 5 years. Um, in the future, I think this average will be much higher. And so, we should keep that in mind because they had a year that was negative, which is an outlier of the last 30 years. But I brought in from the most recent quarters their cash and debt. They've got more debt than cash, but they do have $28 billion of cash, which is a lot. Um, Something like 4 billion shares outstanding. And then based on conservative projections based on their past performance and looking at this from a big picture view, I use my growth rates conservatively, even though I think the foundry business is a huge growth driver. I think their growth could be more than 4% a year in years two, three, four, and five. But I've just set the growth rates at four over the next 5 years, year six, year 10, growth at 3%, long term growth at 2%, 10% discount rate, $46 stock value, $33. So I'm showing it as uh, pretty overpriced after its 79% run here. Understanding that uh, these free cash flow numbers and these growth numbers, either one or both of them may be low. I'm not going to adjust those, but I'll lower the required rate of return to 7.5%, which is a historical average for stocks. Just understand that some of this stuff is kind of fluid here. But $46 stock with a lower required rate of return um, at $50. And I guess let's just come back in here just for fun because I can do whatever I want. Like the video, subscribe to the channel. Um, let's take their growth rate up to a higher level and let's just give them a little bit higher free cash flow. Okay, so in a pretty optimistic situation here, um, I think it's been a lot higher than that actually. Here, let's do that. Okay, and so this is around the price that I started investing in the company. This was the value that I was seeing was in that $50 to $60 range, because the 1 year of losing money was really heavily tied to building that facility, which we know they can get nice returns in the future on. So what I'll say is, I think the stock is currently about fair value. If you've held it, it's about fair value, maybe a little bit above fair value. But if you're looking to enter this over the next, 15 or 20 years, I wouldn't go all in, but I think you could open a position. If you've held it down for either 2 years or 12 years, I salute you. But right now, the stock is a little bit over fair value, nothing crazy. And I see really good things with this company in the future. But you got to be patient, like we showed you. So thanks for stopping by. We'll see you in the next one. Make sure to hit like and subscribe on the way out. And this is not financial advice. Thank you.